In this video, we're going to go over what a call option is and what a put option is. For most of the strategies, and especially the ones that I talked about, and we use specifically in this series for SFW and ratio trading. SFW stands for small frequent wins, and that's a strategy that I've developed proprietary to my system. Ratio trading is very similar to pair trading, but it's a little bit different, and we're going to get into that a little bit later. But right now, because most of the strategies that I'm going to present you with use call options and put options, it's important to get a good, solid foundation for understanding what a call option and a put option is and the different variables that affect the prices of call options and put options. So let's start with a call option. In the screen in front of you, there's what's called an option chain. That means that there are various different options available for one particular instrument. In this case, it's the PowerShares QQQs, which is an ETF. Now, it starts out with a strike price of 31, and it goes all the way up to a strike price of 76 in this case. I'm sorry, it goes all the way down to 27. It starts with a strike price of 27 and it ends with a strike price of 76. Those are the only strike prices available for this particular ETF. On the left side you have call options, and on the right side you have put options. Now, a call option gives the owner the right, but not the obligation, to purchase a specific security at a set price during a set period of time. In other words, this particular option chain that we're looking at expires in 7 days. These are the December 2011 options, call options and put options. So a person who is interested in seeing the Qs go up would buy a call option. A person who is interested in playing from the short side of this market would buy a put option. So if they thought the Qs were going down, they would buy a put option. Now, the buyer of a option call wants the stock market to go up. The seller of a call wants the stock market to go down, or at least stay very near its current level. And there's specific reasons for that we'll go into very shortly. Everything highlighted in gray here on both sides, we'll start with the calls first, are in the money calls. And it is one strike price lower than the actual level of this financial instrument. For example, if you see the line right here at 56, these are what are called at the money calls. It's very close to the current price of the financial instrument, in this case the ETF. Anything below that on the call side is what's considered to be in the money. Anything above that strike price, above the current price of the ETF, is considered to be out of the money. It's at least one strike price higher than the actual level of the ETF. Now, the premium, these are the prices. This is the bid and the ask for this ETF options based on the strike price. And what you do is you pay a premium. Out of the money options also have a premium as well. But the premium of an in the money call, that means anything below the current strike price, has two components. It has a time value and an intrinsic value, or real value. The intrinsic value is determined by subtracting the strike price of the call from the actual level of the ETF or financial instrument. In this case, a 56 strike price, which is currently the current market price, $56.12 of this ETF, subtracted from 50 gives you a value of approximately $6.12. That's the strike price of 50 minus the current stock price of $56.12 gives you an intrinsic value or real value of $6.12. Now you can see that the 50 strike price call in this case is actually selling for more than $6.12. In that case, the remaining portion of the premium that you would pay for this call is called time value, and it represents the value investors place on the time remaining prior to the call's expiration date. So there's an additional value on top of its intrinsic value that gives it its price. An out-of-the-money call has no intrinsic value. In other words, there's no real value to these prices down here below, above the strike price. The 58, the 59, the 57, the 60 strike price calls. All of these calls with a price of 60 cents, 28 cents, 11 cents, 5 cents, and 2 cents have no intrinsic value. The entire premium is time value, reflecting the investor's opinion regarding the likelihood that the stock market will go up during the time the call has remaining before its expiration date. In this case, the expiration date is in 7 days. That means it has approximately 1 week left of trading potential. If you were to purchase a call at the 57 level for 60 cents, in order for you to break even on that trade, the market would have to rise, the Qs would have to rise to $57.60 in order for you to break even. If it rose to $57, exactly the same price as the strike, you would lose the entire 60 cents of time value that was present when you purchased this call. If you were to purchase this call, the December 11th 50 calls, and it rose to $57, you would have a profit of a premium would be $7 for this 50 call if the market rose to $57 at expiration, giving you a value of $7, making you a profit of approximately 72 cents. So which is better? Well, in most cases when you're buying calls, you're better off, if you believe the market will rise over the time period that you are holding the call, to buy intrinsic value, more intrinsic value, and less time value. So in this case, buying the 50 calls would give you a profit of approximately 72 cents. If you purchased the 57 calls, you would lose 60 cents if the market rose to 57. Let's talk about put options. A put option gives the owner the right but not the obligation to sell a specific security at a set price during a set period of time. Exactly the same as a call, the only difference being that the owner of a put option is looking for the Qs to decline in price, and that's how they would make their money. In the same way that we purchased an in-the-money option for the Qs, the call option at the 50 strike price, we could see that if it rose just to 57, we would have a profit of 72 cents. If we purchased a put option at the 60 level and the Qs declined to 55, we would have a $1.04 profit, potentially, if we purchased the put at the 60 level. If it declined to 55 and we decided to buy this 55 put, and the Qs declined exactly to 55, since we are only buying time value and we are not buying intrinsic value, that 65 cents would be lost. We would have purchased that and we would have lost the entire 65 cents of our purchase because it landed right at our strike price. It would have to rise to, or have to decline rather, to $54.40 in order for us to give us a break-even point. We would have to be at least 65 cents in the money at expiration for us just to break even. That's why in most cases some of the strategies that people take advantage of are selling out of the money options, because they realize that for the most part the only thing that they're actually buying is the time value. They're not buying any type of real value or intrinsic value in the option itself, and they're going to let time work in their favor so that the option that they've sold generates additional cash for them. And that's one of the strategies that we're going to be talking about as we go along. So a call option, generally you want to purchase a call option when you're bullish on a stock or ETF. And the best way to purchase a call option is by buying intrinsic value and buying it in the money. And if you believe that a stock is going to fall, if you believe it is going to go down in price, then you'd want to buy a put option. And generally the best value put options are going to be in the money with some intrinsic value so that you can take advantage of the decline that you see coming. Part of the difficulty of trading in options is thinking that you're going to be getting a better deal by buying a lower priced option that is out of the money if you think there's going to be a big move in the stock. And in many cases, if there is a very large move in the stock, you are better off buying a out of the money put option because the returns can be dramatic. However, you have the risk of time. In many cases, an anticipated decline doesn't come about, so you're ending up purchasing out of the money put options that may expire totally worthless. The same thing with a call option. If you purchase an out of the money call option, if you're looking for a big move up in the stock and that doesn't happen, generally your option will decline dramatically. So even though you have maybe a small investment in that option, you will see your options decline in price as we get closer to the expiration date. There's a couple of points that I really want to make about call options and put options. In general, if you're buying an option, you want to buy as much intrinsic value as you possibly can. If you're selling options, you want to buy as much time value, you sell as much time value rather as you possibly can. In the strategies that we're going to be using, for the most part, we're going to be selling time value. That's what professional traders do. They will sell the time value knowing that for the most part, 90% of the time, markets, doesn't matter if it's a stock or if it's a ETF, will generally trade in a sideways consolidation movement. 10% of the time, stocks will actually trend. And so we want to play the odds. We want to play the 90% of the time in which stocks can just simply move sideways. Now, one of the biggest factors that we're going to be talking about whether or not we should when we should be selling options that are out of the money in order to generate income in our small frequent win, the SFW strategy, is by volatility. Now, we're going to be talking about the Greeks in a future video, but the most important Greek that we could focus on as we go through these strategies is volatility, is the Vega. Volatility and Vega are our friends. They can also be our enemies, but we're going to be using them in some unique ways in order to generate profits in the markets. In the small frequent win strategy, we're going to be looking to generate a consistent and reliable income from the markets. And we're going to be using Vega to determine when we should enter and exit our trades. Very important strategy, very important way to be looking at the markets. It's a more professional way to look at the markets. Most people trade on impulse, as I mentioned in the first video, and they trade on tips, and they also trade on rumors, and they trade on, and most importantly, they trade on the feeling that they have about the market at any one particular time. And that is exactly the wrong way to trade. You have to look at the numbers of your trades. You have to look at all of the factors that will affect your trade, and then use probabilities to determine whether or not you're going to be successful in any one particular trade. So these are options. If you have any questions about options whatsoever, we're going to be talking and using examples of options as we go through in the next video. I'm going to show you a little bit more about how time value affects an option, how options change in price if they're in the money or out of the money, as well as how Vega would affect an option's price. So this is a very basic introduction to options. Now, one thing that you need to remember is that when you purchase an option, when you buy an option, the most you can lose is the price of that option. So, for example, if you were to purchase just one of these December 11th 50 strike price calls, the most you would lose is the price that you paid for that option. If you sold an option, for example, if you were looking at selling one of these options for 11 cents at the 59 strike price because you didn't think the Qs would rise above the 59 strike price level, and you sold that option, and all of a sudden the Qs run up to $100, well, your potential liability and your potential loss could be unlimited because you are the seller of that option. You have to buy it back at any price that the stock was selling for. If you purchase the option, once it expires, once it goes below your strike price and there's no intrinsic value whatsoever in that option, your loss is limited and your liability is limited to the price that you paid. You have no further obligation. So it's very important to keep that in mind as we go forward, because remember, our number one rule is preservation of capital, and that's absolutely critical for us to be successful in the market. The second one is to wait for opportunities. We can't be jumping in and out of stocks and options on a regular basis, on a daily basis, and expect to make money. We have to wait for perfect setups. Okay, now in the next video I'm going to give you examples of how options trade in real time, and how they trade on a historical basis, and how they change in price based on the variables that come into play with options, the biggest one being volatility, and we will go into that video in the very next sequence.